Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Thursday. Losing track of time. Thursday edition. Margaret says, how could you do today's topic without the Bond King Bill Addis? Yeah, I know. Kind of difficult. I just thought it was appropriate given the question that I had come in yesterday. Or was it this morning? I don't know. It came through the email from Leslie, which actually is going to steer the show today. But yes, I certainly like to get him to get into the weeds of what's going on with bond markets. But today I'm going to keep it kind of at a higher level. This was based off of, again, a question that came in from Leslie, which was a good one. Leslie says, what are the odds of a big market rally from here? And I'll start with simply looking at the price charts, and then it's going to dovetail, I think actually piggybacks nicely off of the show that we did yesterday. So let me start there, and we'll look at I'll look at the S&P 500 here. And again, I have had this chart mapped out. I have no intention of changing it. I think that we're going to follow this blue impulse and corrective phase, or actually corrective phase and impulse that I have drawn on here, and ultimately see this market drop lower, potentially getting down to about 3,250 on the S&P. At least that's the first leg down. Now, I guess Leslie's wondering, what are the odds of a big rally? So my guess is, Leslie, that you're probably long a bunch of securities and feeling a little bit of pain right now. Certainly, if you're long, you're looking for any reason or any excuse to continue to hold on to your positions. And of course, the overwhelming philosophy is that markets go up over time, right? Just hold on to it and it'll go up over time. However, there's going to be periods of time where markets go down. And I was asked recently by a good friend of mine, like, how long do you think this market's going to be down or continue to go down? I said, I have no clue. I'm no oracle with regards to that. But what we have seen since at least going back into, let's say, 2000 is you might get a sell-off in the markets for a year or two. Right. Currently, we're at 1 year. Right. We've been selling off for almost one full year. Bring up that chart again. I will bring up a vertical line here so we can see when the big sell-off started. Of course, nobody knew that's when the sell-off was beginning. But January 4th of 2022 is when we peaked in the S&P 500. Now, give us another couple months and we will have 1 full year already in a bear market. Now, does that turn into 2 years? Does it turn into 3 years? I don't know. I think maybe if you're pushing it, we'll probably get 2 years out of it. Unless the economic data gets so bad and so sour and we find ourselves in this crazy stagflation environment that we really have a hard time getting out of, then it might last longer. But let's go look at on a monthly basis. Let me go back monthly, look at the I guess you could look at it here. These are the previous 2 monster crashes that we've experienced in recent history, right? Going back to 2000. Well, this sell-off that started back here in September of 2000, well, it sold off pretty aggressively all the way into 2002. So this was about a 2.5 year sell-off in those equity markets where the markets dropped 50% on that S&P 500. This one was much faster that we saw here, peaking out in October of 2007 and bottoming out in 2009, March. You're looking at 18 months, right? So a year and a half. Well, again, we're already a year in, so we can check that box. We still have potentially a bunch more to go to the south side. But as far as what are the odds of a big market rally from here, I think the odds are certainly better that we're going to see a continuation of a sell-off, not necessarily a rally. But what would be the odds, right? If I was a Las Vegas sports bookie, I got to look at this picture and say, what are the odds that I get a significant rally out of here? Well, already I'm going to start with the easy number, right? And again, this is all just speculation and just opinions, but I'm going to run through it like I would analyze it if I was a sports bookie making odds right now for the market to have a big rally up for Leslie. And then I'll look at some charts here, which I think really help at least back up my opinion. If I was to look at just a sideways trending market like we had in the Russell 2000 a couple years back, right, in here, you had a 50-50 chance you're going to see a big rally out of it. Why? Because it was just chopping sideways. It could go anywhere. Here, if we look at current markets on the S&P 500, probability is higher that we're going down simply because that's what the trend has been doing since January. So I'm more inclined to go with the direction of the prevailing trend. Now, do we get a bounce? Certainly we could get a bounce. But if you notice, there really hasn't been I guess, a significant aggressive bounce. We did have one back here that started in June and lasted all the way till mid-August. That was a pretty nice bounce. And what was more important about that one was we actually made a new high, which was kind of surprising. We've done that a couple times. See back here, we just tiptoed across this high back in March of 22 and then sold off from there. So it seems to be that it finds a supply zone, gets everyone thinking that that's a place to go short. It rips up, getting them out of their shorts and going long. At least that's what it did to me. And then rips back down again. So based off this picture, I guess I got to ask myself, where would I expect it to rally to if it did in fact have a rally? Well, I'm going to throw some arbitrary lines on this chart, and these are no means strategic. I'm just slapping lines on because those are potential turning points. And all these little dotted blue lines are areas where you could see price rally back up to and potentially turn. But none of those, at least in my opinion, none of those are really significant strong zones. Nothing really substantial there. So I would have to say, what are the odds of a big market rally from here? I would put it almost in single digits. I would put it down, I'd say 10%. And the main reason for that is you have the prevailing trend here, which is aggressive into the south side, big move down, lower lows, lower highs. But here's where I want to go back into our materials and discussion from yesterday. So just based off the chart, bias has got to be to the short side. One of the challenges I think that is going to pop up is when you look at the way that the markets are thinking. Right now, it's very bearish. Almost everybody is thinking bearish, and that is when you get the bear market rallies, which is why I'm giving it 10%. Otherwise, I would say we're at like 95%. We're going to continue on down 5% rally. The more that we get people saying it's going to keep going down and go down aggressive, that's generally when things start to turn. So let me look at some economic data, some big picture stuff that may help, I guess, bolster my argument for it. The chart we just looked at is the equity markets, right? That's the S&P, which, if you remember yesterday's discussion, I talked about market relationships. And if that S&P is the equity market, that's stocks. Well, you got to look at the next picture, which is bond markets. And, of course, looking at the currency markets. Those two are going to drive stock markets. So let's go and look at what's going on with the bond market. And that's why I called it bond market Blastoff, is look what happened. The last 2 days for the bond market have been aggressive. And this trend that started, obviously the trend started much earlier, but the most recent one started August 2nd. And in that small window of time, right? So here we are a little bit over 2 months, call it 2.5 months since that point right here on August 2nd. The bond market has increased to the tune of 68%. That is incredible. Like, you don't usually see moves in the bond market like that, but that's the yield. Yield has increased almost 68% in 2.5 months. You're seeing 30-year fixed rate mortgages over 7%, and I can verify that by showing you this chart here. Here is the 30-year fixed rate mortgage. Gotta love the Federal Reserve for putting this one together for us. Thank you for doing some kind of work. Let me zoom out here. I messed it up. Okay, here is the most recent move up, and let's just look at it from, let's just say 2012, right? So you saw these fluctuations where a 30-year fixed rate mortgage back in 2013 is 4.5%. We spiked up to a high of almost 5% in 2018, and then plummeted to a low. And again, anybody who locked in a 30-year fixed rate mortgage at 2.65%, go out and buy yourself a nice beer and cheers yourself. You did an amazing job. But look where we are now. This is a huge surge to the upside. This, as I've been talking about, is going to put more pressure on the equity markets. But let's go all the way back down to, let's call it the 1970s. Right here you can see the late 70s into the 1980s. You have had big surges like this before, and they went on for quite some time. And I have a feeling that this surge may go on for quite some time as well with our 10-year and our 30-year fixed rate mortgage. But this blast off that I'm alluding to, this is what's driving the equity markets. If this trend continues, then the equity market's going to go down. As much as they're going to have great earnings, and let's be honest, today's earnings were badass. Here's earnings for today. AT&T beat earnings, Blackstone Group crushed earnings, Ericsson beat earnings, American Airlines beat earnings, CSX beat earnings, Philip Morris beat earnings, Union Pacific beat earnings. The only one that missed on earnings was Freeport-McMoRan, which is interesting because we saw Alcoa miss the other day as well. Natural resource companies not doing so well on the earnings front, but everybody's crushing earnings. And again, I think that has a lot to do with they lowered the bar there. But if earnings are great, you'd think this market would be surging. And it's kind of like the salmon trying to swim upstream. Some make it, a lot don't. And the way that this bond market's pushing, that's why I wanted to title today's show Bond Market Blastoff. If this continues, which I feel it will, I think that you're going to see this number, where right now it's 4.23. I think by December, you will see this thing at 5%. If we get 5%, it's further pain, I think, for the markets going forward. Now, Tom just sent in a comment here, which I haven't read, but I saw the midterm comment. It says, after the midterms, there is a good chance that we can turn to good energy policy, which will reduce inflation and also weaken our enemies that produce oil. Yeah, I'm not sure about that, because if you're looking at the macroeconomic picture, and let's say that you're the incumbent and you're the Democrats and you want to maintain your position, you have to do things to get this market under control, right? Obviously, the situation that's going on right now looks great for Republicans, because they can point the finger and go, see, Democrats did this. So if the Democrats wish to hold office, they're going to have to do something to fix this. And maybe we do get some last-minute changes right as we get into, not necessarily the midterms, because they're going to happen next week, but certainly by the time we get to presidential elections, to help change this picture and help the current administration stay in office. That's just what the political parties would do, and it'd be the same thing if the Republicans were president right now. They would do something to help fix this right at the end. But I just don't really see that happening right now for the midterms. Now, as I mentioned, the bond market is driving things to the south side for equities, right? It's raising the cost of capital. But as I pointed out the other day, even a bigger market is going to be that dollar index. So here's your Dixie. The dollar index, fortunately, did not have a surge today. But if that 10-year keeps moving up, the odds are pretty good you're going to see this dollar start to surge again. I don't know if remember we talked about this one bad boy right here, this Japanese yen, talking about 150 being the target. Scott McCormick posted this January 5th of this year saying 150 is his target. A lot of people are looking at that number as well. It's just the magnitude of how sharp this has moved. There's a lot of speculation that rates are going to go significantly higher. I kind of think that they're going to slow down on their rate hikes here. They'll probably do 75 at the next meeting, 75 at the December meeting, and I think they're going to back off from there just to see what's happening, because it's been a really aggressive pop to the upside. But that said, if we get another 75 in the November meeting, another 75 in December, I think you can all pretty much surmise the impact that might have on these markets. And I don't believe it's going to be good. So, Leslie, to answer your question about what are the odds of a big market rally from here, you might get a small rally, just kind of a relief rally. But unless something fundamentally changes, I think you're going to see these equity markets continue to drift down. I don't think it's going to be a straight down, oh my God, parabolic collapse in the equity markets. But I think it'll be a drift, just a slow drift down. And maybe my line that I have drawn in this S&P is a little bit too steep, but it kind of does match up with the chart that we see here. Let me go back to a weekly. This makes it a little bit easier on us. Maybe the line doesn't have that slope. Maybe it looks something more like this, which, that takes us all the way out to April of next year, drifting down. And does it take till April to drop all the way down to 3250 on the S&P? Yeah, it could. It really depends on what news comes out or what fear factor stuff is precipitated by the media. Keep in mind, my ultimate number is this one way down here, which is 2,400, which is 50% off of that peak. And I think that could very easily happen. How about a stock buyback rally? Well, you can't just issue a stock buyback. It's not like you can just automatically do that. There are certain rules that the SEC has in place. For example, you have to have a certain amount of positive cash flow, right? You have to have earnings and to buy back your shares. You heard Elon Musk talk about that, and I think that next year, I was hoping he would announce it yesterday. Took a nice little loss on my my Tesla options. Is what it is. Luckily, I didn't have all of the contracts. I just had one. But Elon Musk, the expectation was he was going to make an announcement that they were going to do a share buyback program, but he pretty much talked about it and bumped it out to next year. And I think that next year is when he's going to start to do that. Now, there's conversations there is, does Tesla get in trouble for saying they're going to do a share buyback and they haven't locked it in? Well, I think that by making that statement, Elon Musk is pretty much forced himself now to do a share buyback next year, because if he doesn't, it could look like stock manipulation. Again, remember, Elon Musk is trying to buy Twitter. Apparently, he's about $4 to $8 billion short on the funds that he needs. So one thing that he could do would be to juice the price of Tesla, sell out more of his shares, because a bulk of his wealth is sitting in Tesla shares, take that $8 billion out, and then Tesla falls apart. So a lot of speculation on what's going to happen here with Tesla. I am not short right now. I have no Tesla holdings, so call it cash for me on Tesla. I was thinking we might see a little bit of a bounce back up, but we didn't get it, and I paid the financial price. Anybody else here short on Tesla? What else do I got? So yeah, I don't think you'll see stock buybacks so much right now. That's when money is cheap and they can borrow money and buy back their shares to drive up the price. I mean, it's funny because companies would borrow money at, let's say, 5%, or actually less than that. Let's say they borrow money at 3%, buy back all their shares with this borrowed money and jack their share price up 4%. What a deal. You borrow it at 3%, jack your share price up 4 or 5%. Awesome. Let's do that all day long. That's share buybacks for you. All right, so where was I? I can understand good earnings reports, but why aren't companies giving soft guidance when we all anticipate the market going lower? It's a good question, John. I haven't really heard anybody give atrocious forecast, right? They haven't been that great. A lot of them have cited, slowing economic conditions may weigh on their business going forward, and maybe that's just the expectation across the board. But I haven't heard anybody. Remember a few months back we had Walmart make that statement that they're going to take a big hit. Let's look at Walmart's chart here so I can validate that one. This is the weekly. Yeah, it was right here. This was that big sell-off where Walmart was like, hey, we're expecting big damage. That was this from 149 all the way down here to 116, roughly 116. That was Walmart coming out with a very bad forecast going forward. And who knows, maybe that was an opportunity for Walmart insiders to buy their shares. Again, I think that this is one gigantic rigged house of cards game that you have to step back and take any comment or action that's made by an executive or an analyst with a grain of salt and think there's an ulterior motive there. Christmas rally. Yeah, I think if you ask what are the odds or probability of a Santa Claus rally, probably pretty good. You'll get a lot of people selling losses, holding on to winners. Of course, there's not going to be that many winners to hold on to, so you get window dressing, which generally helps. But I do think that history has proven that there is that Santa Claus rally. When we get closer to the end of the year, we'll look at the actual statistics and data on it. But if the statistics show that historically the last 5 days and the first 2 days of the year, the Santa Claus rally has a positive gain. I think it was something like 3% up move for that 7-day window. Then I have to go with the probability. And that's going back to the 1950s. So at this point, I will probably say, yeah, we'll probably have a Santa Claus rally. We generally do more often than not. So right there, the odds are in my favor by saying, yes, we will. That said, who the heck knows? Right now the picture looks pretty gloomy. I will look at the rate forecast for you so you guys can see that one. Let's go to... So not much has changed here. Oh, we spoke of the Christmas rally. I mean, it happens. Like I say, it's just pure statistics. So we haven't really changed much in the last 24 hours. We've moved up a little bit, but these numbers haven't changed really for about the past week. Right? It seems pretty solid that we're going to get a 75 basis point increase. But here's where it starts to get interesting. Notice that right now we're at 3.25% on the Fed funds rate, right? Target's going to be 4 for the November 2nd meeting, which means a 75 basis point increase. But let's look out a year, right? Let's just see what the expectations are. And I assure you it will not be this because it usually is never in line with this. Let's go out 1 year. I'm going to go out to November 1st of next year. Here is your rate distribution. And you can see there's a 31% chance that we're going to have, I guess the medium expectation, the bell curve here, the high probability, 31.2% chance that we're going to have a 5% Fed funds rate by then. Now, if we have a 5% Fed funds rate, that to me says that the 10-year is probably going to be at 6%, which means that 30-year fixed rate mortgage is going to be closer to 9%. maybe even 10%. So, you might actually see some double-digit mortgages by next year if these rate increases do in fact get to these levels. Now, that sounds crazy, but when you look at the economic data that comes out, numbers are actually pretty decent. Here's what we had cooking for today. This is your economic calendar for today. I'll jump right to the U.S. stuff, and maybe we'll talk about the international as well. But for the U.S., you see existing home sales. So they were expecting a contraction in existing home sales from 4.78 million to 4.69 million. So dropping roughly 90,000 homes. Okay, great. Well, we actually came out at 4.71, so it dropped 70,000 homes. So better than expected, but still showing a decline in existing home sales. And I think that this is just the beginning, because you are hearing so much about people backing out of mortgages and lowering their offer rates because they're just not selling their homes, etc. So that's definitely something that we'll want to keep an eye on, is that housing market stuff. I've been looking at it quite a bit on this program, and I try to incorporate those into the show on a regular basis. Now, here is a chart of existing home sales just to really drive this home. Let's look at the big picture first. Right, so here's your big picture, and you can see going back in 2006. Let's go further. Here's in 2000. Notice that the last time that we saw sell-offs in existing home sales, or declines in existing home sales, akin to what we have now, was back in 2005 and 6. That's before the markets crashed. Right, existing home sales peaked in October of 2005, but you're like, wait a minute, wasn't the financial crisis in late 2007? Yeah, it was. But there was this leading aspect to it, that the housing market was kind of leading the markets overall. And in this case, if that in fact rings true, and we see a similar situation happen, well, that this sell-off right now, this decline in existing home sales, may just be a precursor, and another year or two out, then we see the markets really take a dive. So I don't think it'll be as extreme as we saw back here in 2005 to 2009, but it is kind of noteworthy to see such a sharp decline in this bullish market phase that we've been in. Really, really big drawback here. We've dropped probably 33%. Yeah, we've got 6.5 to 4.7, so roughly 30% decline in existing home sales. That's pretty significant in my book, and that could get much, much worse going forward. But we'll have to look at other data as well. The other pieces of economic data, like the Empire State Manufacturing Index, which happened on Monday, remember that showed worsening situations in the eyes of the Fed in New York. Here you see Philly also having poor situations. It's better than it was the previous month, but not as good as expectations. So this is a fairly negative number. Of course, the good news, which many people will cite, is unemployment claims. Unemployment claims are looking good. No problem, Big Eb. You're always welcome to be late. Now that you're on the West Coast, best coast, you can be late. It's fine. We'll let you slide. All right. Wow. A quick one today. So that was, let me see, there was really only one question that came in, so I was kind of surprised on that. If you guys have more questions you want me to answer, feel free to type them in the chat and we'll get to some of those. If not, we'll make it a 30-minute show like I've always dreamed about doing. All right, here's another question that came in. And again, if you want me to go deeper into some of that topic, those topic questions, again, I don't think there's a high probability. I think it's actually very, very, very low that you see a big market rally from here to the upside. Probability is much higher that we're going to keep on drifting down. This question came in as well. Of course, I don't trade Apple, but it says, was looking to buy some Apple stock around 135. Thoughts on Apple for Ken? All right, Ken. I don't know whether you picked Apple because you like it or you just know that I just can't stand Apple. APL. So, for me, it's going to be a little, I guess, cynical, because if you look at what Apple has done, they're not really creating anything new. Right, you got your Apple Watch or your iPhone 14, which really doesn't have any new great gadgets or technology. It seems like every time they release a new iPhone, it's got some grandiose new upgrade. I don't think, correct me if I'm wrong, everybody, but doesn't the iPhone 14 just seem like it's minor little increase in quality over the 13? So unless they're creating something that's really going to drive people to it, I just don't see them driving significant growth in sales. Now, of course, there's fanatics here. There's people who probably hate me for even saying anything bad about Apple because you're one of the Apple lunatics, right? And you're camping out to get the iPhone as soon as it comes out. Well, there'll always be the extremes. But I think on average, unless there's something really, really new and innovative coming out, what's going to drive revenue and sales going forward? Of course, they always try to release every year a new phone because they need to get people to buy it, and they build their phones to die in a year or two. Anyway, my battery life is atrocious now, and I think this is a 12? I don't know. It's a relatively new model, but you're going to force yourself to buy a new phone just because the battery dies. So I look at that, and I'm not that interested. I look at the price chart, which we have here, and I'm still not that interested, really. I mean, look what's happened to Apple. Right, here is, let's do it on a weekly, it's a little bit easier to understand where we come from. But if you look at this, Apple's been on just an unbelievable tear since the 90s. I mean, it's been absolutely incredible. This obviously has several splits involved with it, but going back to 1997, Apple was not trading at 11 cents, so don't think that was the case. It's all been split. However, if you look at this price action, it feels like it's just slowly holding here. And to me, that's a sign of a rollover, right? It looks like it actually wants to break down. And of course, because Tom's here, we're on logarithmic. Okay, yeah, we're on logarithmic just to make Tom happy. So there you go, Tom. I look at this last sideways chop that's going on here. This doesn't look very good. I mean, this just looks like sideways consolidation, especially, given all the excitement about markets. It really hasn't done much. Get my magnet off here, and we will do that. So I'd put a little yellow box on here, and I would stay the course with that one. If you're buying at 135, basically I think what you're telling yourself is you're looking to buy at the low end of that trading range, but you're still, as Rob just pointed out, you're still high in the curve. I mean, you're way up there. So unless you think that there's going to be some catalyst to drive Apple to higher highs, we're due for a correction. We're due for a pullback on Apple. And remember, Apple is one of the biggest weighted components of the S&P 500 and the Dow. I mean, if Apple starts to fall apart, these markets are going to come down much quicker. I don't remember off the top of my head what the weighting is for Apple in the NASDAQ 100, but let's really quickly look. Where's TJ180 NASDAQ 100 weightings? Okay, so they have there's actually a really cool site. I think it's CliK Charts. So here's Apple's weighting in the NASDAQ 100, and you're currently looking at 13.6%. I mean, look, Apple and Microsoft together represent roughly 24%. That is monstrous. And if that does pull, right, if we see a breakdown in Apple, which this chart, to me, kind of feel like it is going to break down. Why? Because the overall market is drifting down, making lower lows. Apple's kind of this line in the sand holding it. You shall not pass below 130. Well, if it does, you could see it hit this 95 mark pretty quick. There's a pretty nice demand zone right around the 94 mark, 94, 95 mark. That would be the next logical target. And I'll tell you, if Apple drops all the way down to $95 from 130, S&P is going to take a big dive. So is the NASDAQ. Let's see what the weighting is for the NASDAQ on the S&P. I think I can pull that one up here. S&P 500. Weight analysis. Oh, nope. Dang it. Here we go. Here's the company. Sorry. Apple, 7% of the S&P 500. Microsoft is 5.7%. So those two alone, again, making up roughly 14% of 503 stocks. Crazy. Yep, Rob. It's actually, the power of Microsoft and Apple is 1/4 of all of the NASDAQ 100. That's kind of crazy. That is that's a risk factor, right? For most people, they look at it and go, no big deal. Who cares? Who cares if it's 25% or 10% or 70%? It matters when things sell off. Actually, it matters when things have big rallies too. Like Apple's had tremendous rallies for the past decade, and that pulling brings up the NASDAQ 100. So if you're trading the NASDAQ 100, great. But live by the sword, die by the sword. If we see Apple or Microsoft, heck, even Amazon, which is about 3.2%, this is the S&P 500. So just Apple and Microsoft making up roughly 14% of 500 plus companies. That's remarkable. And again, any big fall here in those could have catastrophic effects for our market. MSFT. Right, Microsoft is not as strong. Microsoft actually looks like it's following lockstep with the equity markets, making lower lows, lower highs. This is Microsoft. This is the S&P 500. All right, they look almost identical. Wow, very close, right? You're definitely seeing weakness in Microsoft that mirrors the current downtrend in the S&P, and here's your NASDAQ, so you can see the same picture there. Apple really has been holding it. Big guess is Apple's P of 23 is still too high, and especially with lower earnings announcements next week. Yeah, earnings, we got a lot of good earnings announcements next week, and we'll see what those numbers hold, but I just don't see them getting a big boost to bump to all-time highs. I mean, there's just so much negative stuff, and I think I challenged you guys to say, tell me something that's going to be a catalyst for good for our markets going forward. Fed said that they're going to be doing unwinding of the balance sheet. That reduces dollar money supply. That makes dollar go up even more. Yields are surging on the 10-year and the 30-year, not even the 2-year, but the short of the yield curve is definitely steepening up. Then you have unemployment. They've made it very clear unemployment's going to start to rise. Housing market's starting to sell off. So I don't even think we've seen like the big pain in housing market. We're seeing some weakness in it, but we haven't seen anything really big sell off. That's questionable if we'll get a big down move out there. But tell you what, when mortgages start to get to 10, 12, 13%, it's hard pressed for people to be buying those types of properties and turning a profit. All right, so Ken, there you go. That was my thoughts on Apple. I personally would not buy Apple, period, just because of my trading plan, which in 2001, I think 2000 or 2001, I wrote in there that I can never trade Apple again, and it's become kind of a cornerstone that I hang my hat on in my trading plan. So I'll never trade Apple again. That said, I wouldn't buy it if I could based off that price chart. If anything, I'm looking more for shorting opportunities across the board. I would be more inclined to go with ETFs because of the diversification of those markets and not get stuck with single stock risk, and just look to go short some of these broad market indexes and sort of slowly ride them down, just like many people were riding that slow move up in the equity markets. All right, let me go and show you the economic calendar and the end of the day stuff here. And you guys have some more questions, feel free to send them on in and I will get to those. Here's what's going on for tomorrow. Obviously, Friday is a light day, but you do have some big names. Verizon, Schlumberger. Don't ask me why I always say it's Schlumberger. It just sounds really... Schlumberger sounds so mean, like just dirty. Schlumberger gives a nice French twist and makes it sound regal. HCA, Healthcare, and then American Express looking for earnings beat tomorrow. And again, remember, most of the financials have beat. I think every financial firm that's reported has beat already. All right, let's see. Would you short it for profits on Apple? I mean, look, if I take out my trading plan, which says I cannot trade Apple, and let's assume that I could trade it, I would be waiting for a break below 130. All right, that's where I would be looking to go short on Apple as a close below 130. Now we can go back here to this day. What was that? June 13th of this year. You can see it had a low of 129. So it did break 130, but it has not closed below 130. So I'm just kind of using that whole number psychology. The lowest close that it's had in the past year or so on a weekly basis is 131.56. And we're currently at 143. So a little bit of ways to go before we get down below those lows or to those lows. But that's the line that I would be using, Rob, would be to wait for a break below 130. I want to wait for confirmation that this thing is in fact weak. And, I think what'll happen is you look at let's look at the companies that have kept this market up, or at least not kept it up, but what vaulted this market, right? When we look back at this S&P 500, this big move from the lows on March 23rd of 2020, when the S&P was down at around 2180, we peaked at 47.78. That's over a 100% rate of return in under 2 years. That is incredible. That's amazing market moves. This was not the broad market. This was really done because of Apple, right? So if we go, let's go to those March lows on Apple, which is right there, to the peak. Apple was up 245%. Let's go to, that's pretty funny, Big Ab. Let's go to Amazon. Right, so we'll go from those March lows. Let me go snap mode here, and from there to the peak, which is roughly there, 132. So Amazon wasn't the big boom to the upside, but it certainly has been tech. Here's Microsoft from those lows to our peak. Microsoft, 160%. Let's see, what else was there? Oh, Google. Sorry, Alphabet. Google crushing it. And remember, Google is on your top. That's 200%. in just that one small window of time, whereas the S&P 500, if we look at those gains, you're looking at about 120. So clearly the FANG stocks, Facebook, I didn't look at Facebook. Let's add on Facebook. Facebook may not have been that big of a catalyst because it's just falling apart right now. But the move from those March lows on Facebook was pretty significant, and you saw 180% move. And that's really what propelled them. But how much PPP money did they give Apple? I'm sure they got quite a bit of money. Even though they're one of the richest companies on earth, I mean, everybody was filing for PPP money. This is something that I wish, if I could get into politics, I would actually have a special task force, and I would go county by county, and I would audit people who got PPP money and see who was actually closed. For example, Newport Beach here, there's a guy, I've mentioned this before, he owns a bar, and he actually, I think he owns like 7 bars around here, and rumor was he was collecting all the PPP money, and he stayed open the entire time. To me, that's fraud, but anyway, a lot of people collect that PPP money. What else do I have? All right, so that was your economic calendar. Earnings calendar. Let's go look at your economics. For the U.S., you have nothing that's really that great for tomorrow, so maybe it'll be a little bit of a breather, but you do have some interesting stuff going on for the U.K. You can see there you have retail sales numbers coming out at 2 a.m. That's going to be an interesting one. They're expecting their numbers to get better. It was negative 1.6%. They're expecting a negative 0.5, so that may help your British pound there. Canada also has retail sales expected to get significantly better than it was, a negative 2.5. They're expecting to be a positive 0.2, and that's pretty much it for economic announcements. $60 billion in fraud just in California alone. It bothers me because there's one of my favorite places to go to. They followed to the letter of the law what they were supposed to do. Close down, the government said, so they shut down. Can only do outside see, and they were really trying to be careful and make sure they did everything right, whereas some people were absolutely reckless. And you know, that individual that I mentioned that was that owns all these bars, think of how much money that guy made, because not only did he collect all this PPP money, but all his employees were still working and spreading COVID, because there was actually a bunch of outbreaks down there at that specific bar. If you go to Wild Goose, that was one that was just a spreader event for COVID. But he was also packed because he was one of the only places that are open. And a lot of people are like, I don't want to be told what to do. I'm going to go out anyway. So, yep, options expiration tomorrow. So I expect weird swings. Every time there's options expiration, it always seems weird price action to me. So good news is... cue the red candle for tomorrow? Possibly. We might see a red candle. I don't know. Based off what I see on these charts, let's go here, go back to the daily. You know, you've had 2 little pullbacks. Do we get back down to this, 3,600 on S&P? I don't know. I'm not going to trade tomorrow. I'm going to just take it easy and watch what happens and build myself a position to get ready to make some options plays on Monday. So I'll be pretty quiet out there tomorrow. Diesel crisis depends as inventories fail to do so. All right. Well, I think that's going to do it for me. We're observation rate in October has been up 8 of the last big. Someone's addicted to the Trader's Almanac, aren't you? I showed the Trader's Almanac. I had the guy in the program that runs the company for Trader's Almanac, and I would encourage you to check it out. But boy, that's a good book. You find all these crazy little statistics out there that are there for a reason, right? These numbers that exist for the Santa Claus rally and the January effect, all of it. If you get yourself if you got a good trader friend, buy him the Trader's Almanac. That's always a great book. All right, that's going to do it for me. I'm going to wrap it up early. I'm going to go get my Halloween decorations done and get everything ready. Gallo says, Merlin, if someone hands me a bunch of money for free, I would not be asking questions. I'm not going to ask questions either, but the rule for taking that money, Gallo, was your business was closed. That's why you took that money, because your business was supposed to be closed. You were told to shut down and you didn't do that. That's fraud. That's all I'm saying. Let's see what to do. All right. Yep. Yeah. All right. That's good. Well, I'm going to read all your questions for the rest of the day. Anyway, give me comments, questions, feedback. Leslie, who sent in that question about the big market bounce. Don't think you're going to get one. I would put it a 10% chance going forward here. Certainly at some point we're going to get a big market rally, but I think we have more downside movement to go before we finally get there. If you have a question, topic you want answered for tomorrow, I'm going to do all Q&A. I got no guests for tomorrow. So send in your or put your questions down below the YouTube video, as many of you have done. I appreciate the comments there, both good and bad. I've got some haters developing out there for my political views, apparently. That was kind of interesting. But if you have any comments, questions, feedback, feel free to put that down below the YouTube video or email me. It's on the screen, TraderMerlin@gmail.com. Have a fantastic Friday, everybody. I will see you then. Take care.